Hey, everybody. Welcome to today's LP Institute panel on learning how to be a limited partner. I'm Sam Hewlett. I'm an active angel and LP, and I help run the LP Institute. So just a quick word on that. The LP Institute is roughly an 8-week program for limited partners, offering education and deal flow. Our third cohort starts in October, so get your applications in as soon as you can. We'll post a link to the application in the chat, just momentarily. So the purpose of today's panel is really to provide an overview of the fund evaluation process to help you make informed investment decisions and also manage your commitments as an LP. So we're really excited to have Marco Hara with us today. Marco runs Decil Capital, which is our own fund of funds. He has an incredible amount of rich experience and expertise, and that will become quite obvious once we get into this session. So we'll hear more from Marco in a second. Just a couple of housekeeping items here. Today's session is meant to be really interactive. You'll see sort of the emoji reaction buttons here in AirMeet. Please use those liberally. We would love to hear from you. And if you've got any questions, you can just start populating those into the Q&A section, which you should see on sort of the right-hand side. And we'll have plenty of time for Q&A. And then also, toward the end of the session, we have time set aside for you to connect with your fellow LPs in attendance today. So we'll have a few different networking tables where you can get to kind of know each other, ask us questions about the program, etc. So we'll definitely make sure we have about probably 20 minutes or so for that toward the end. And finally, if you enjoy the session and you're super gung-ho to be an LP, you want to learn more, we've got another great event that's coming up next week that we're calling Top Lessons Learned from Our LPs. So you'll actually get to hear from some of our star graduates from the LP Institute, sharing their real honest experience, having gone through the program, having made initial fund investments, and kind of learning what helped to shape some of their early success. And we'll drop a registration link for that event as well into the chat. So without further ado, let's get started. Welcome, Marco. I'd love to ask if you might, just say a couple of sentences about your background and kind of introduce yourself.
Okay, thank you, Sam. I started in 1986. I founded my first company. It went belly up in 2 years. Then I founded and co-founded 4 other companies that went better. Got some exits in the 90s. Got involved in family office business. Around year 2000, I was asked to join a venture capital company. I was a GP investing in tech companies, mostly pre-seed, seed, and Series A. I spent a couple of 6-7 years there. We got good exits. We were lucky enough to get an exit on the entire portfolio, which doesn't happen that often. Then 2006, I was asked to join a pension fund to run their private investment program, including venture capital. I spent there for about 17 years, investing in funds, direct investments, co-investments. I have been involved in around 250 or 60 or so fund investments, and then 50 to 60 directs and about the same number of co-investments. I've been investing in emerging managers for 25 years, around 25 years, and we did have a pretty successful program in the pension fund for emerging managers, which started around 2010. I joined Decil Capital for about a year ago and running that investment program we have there in emerging managers.
Amazing. So 250 fund investments, 60 co-investments. If that doesn't deserve an emoji reaction, I don't know what does. That's a really amazing experience. Um, so maybe we can, kind of take a step back and think about things from a more macro level before we, really kind of dive into specifics on fund evaluation. Marco, why is venture capital such a unique asset class? I know there's this little thing called the power law,
Yeah.
but would love to hear from you about what you think makes it, such a unique space.
Yes, indeed. I would say that the first thing we have to understand that it's basically high risk, high reward type of investment. Um, if you're investing in startups or early stage companies, there is a high failure ratio rate. On the other hand, if you're lucky enough or successful, we have the skill set, you get very high returns there as well, outsized returns. The other thing is that you have to be prepared for long-term illiquidity. It normally takes at least 5 to 10 years to get exits, and you kind of have to understand that. And there is a secondary market nowadays for fund investments, but it's still relatively small. Also, when it comes to successful GPs, uh, they normally do have they're active with a portfolio. There is this involvement, and it's very hands-on. It's totally different to invest in public traded companies than to invest in private companies. The other thing is that there is lack of information about these companies because there is no public data on them, and that really means that the GPs they have to rely on due diligence, maybe their markets, industry knowledge, and stuff like that. Information it can be very complex. Um, Also, binary outcomes. Binary means
Yep.
0 1. And in this case, 0 means that you won't get anything, and the 1 means that you can get a lot of money from a basically one investment, and that's also the power law situation. Only a handful of companies generally create the majority of the returns on the fund level. Also, that is the reason most of the VCs do have a diversified portfolio. It's all about disruption and innovation as well, because they try to invest in new markets or innovations, um, basically to get these outsized returns. So it's like that's something that is very important to understand if you're investing in venture capital. The biggest mistake you can do there is to invest in no-brainers, old technologies, uh, old business models. You got to be able to find these, the something that is a little bit different or new. And also, the transactions can be quite complex. It really means that they have these financial models or ways of making these investments into these companies, and also they negotiate all kinds of bells and whistles into these agreements. There should be a strong alignment of interest between LPs, GPs, and founders. They're after growth and outsized returns and exits. Um, in the past, there was no limited availability. It was only reserved for institutions. Nowadays, it's high net worth individuals, accredited investors, family offices, fund of funds. It's getting better in that sense. And the final thing I want to say is that the pricing of these assets is a little bit different because it's not about supply and demand. It's about access and also being able to negotiate the deal. So these are basically what makes it a little bit different from most of the asset classes. There are many differences between these and the publicly traded companies. Long
Yeah,
term,
that
illiquid, high risk, high return, hands on, and stuff like that.
that's really helpful. And by way of setting a little bit more context, so we've mentioned Decel Capital. Could you perhaps, speak a bit about what Decel Capital is, how VC Labs GP Accelerator program kind of fits in, and maybe what even just at a high level of fund of funds is, in case anyone is kind of unaware who's attending today.
Okay, Desal Capital is the investment of the South Group, investing in emerging managers. Most of these managers have been accelerated by VC Lab, which is, I think, the leading accelerator for emerging managers in the world right now. We do have about 45 to 50% market share, or the VC Lab does. And we try to invest in the top managers, try to identify them. We also occasionally invest directly in companies, but most of all, we invest in emerging managers, solo GPs, first-time managers. That's what we do. We try to create outside returns if possible. So basically, I think it's a good um, for fund of funds manager is always good to have a good deal flow. And so far, the deal flow from the VC Lab has been better than I expected.
We have a pretty amazing flywheel here. That's for
Yeah,
sure.
that's true. Yeah, we do
And
have good
so,
information about emerging managers. We know what's going on there.
exactly,
Yeah.
exactly. So, you've invested, both as into funds as an LP and directly into companies. Just kind of curious for a couple of thoughts on some of the differences when evaluating, a fund versus a company. I'm sure we have a number of, angel investors in the audience who are thinking about making their first fund investments. Just help us think about, the approach to one versus the other.
Yes. Obviously, when you invest in a fund or in a fund of funds, you get that instant diversification. That's what you get. On the other hand, when you invest in a fund, it's a blind pool in a way, because sometimes they do have some warehouse deals, but many times they don't have that. Uh, Obviously, with the direct investment, there is this um, higher concentration of risk, which means that the binary outcome is greater for a direct investment than it's for the fund investments. So by investing in a single company, you can get a higher high but lower low than investing in a fund because of that diversification effect. Uh, Investing in a fund as an LP, you can have pretty passive approach, whereas when you're investing in companies, in particular, if you're a lead investor, then you really need to be very hands-on and very active with your investments. Uh, Normally, also fund investments, they should have a certain lifespan. They're normally like 10 plus 2, whereas you don't have that kind of lifespan for a direct investment, which means that you get your exit when you get your exit. So,
Mhm.
so that is one of the big differences. Then, when it comes to due diligence, uh, in particular, if you're investing in startups or emerging managers, it's very much about the team, which means that that part of the due diligence is quite similar, regardless of if you're investing in a fund or a single company. So there are some similarities there as well. But I would say that the biggest difference is basically the risk reward ratio. If you're investing in a one company, if you're lucky enough, you get 2000x. You're never going to get that with a fund investment. But then again, you can get a zero from a direct investment, but it's highly unlikely to get a zero or less than one with a fund investment. So that is one of the main difference there as well. Uh, Also, if you invest in a fund, you don't have any control about the investments that the GP is going to make, and that's what they get paid for. VC funds, they do have their fees, management fee, and also success fee. Direct investments normally don't. But then again, you might have some legal expenses there and due diligence expenses. It's all about diversification and no diversification. But there
Really
are many,
helpful.
many, many ways the due diligence on emerging managers is pretty similar um, as it is to the direct investments. It's very much about the team.
Hmm. Now, we all know, kind of thinking about the role that an LP plays in the ecosystem. We all sort of, intrinsically know, capital is one of the big roles, right, that an LP brings to bear. But, what are some of the other, dynamics of, what makes for a good LP or what the role of an LP can be to a fund manager?
Yeah, yeah, well, I would say that you already mentioned the obvious and the most important function. It's about being able to provide capital. Uh, that is, you just can't escape that. Um, the other thing is that I mean, I know that many LPs, in particular fund of funds, they claim that they're able to help single GPs or even single companies more than they might be able to do. Because if you have like when I left the pension fund, I think we had about 250 funds in our portfolio. It really means that you can't help them that much, and it's more about portfolio management. I would say that the good LPs understand that their main role is the capital, and also to be able to be reliable capital providers and have very long-term perspective. The best GPs, they like LPs who understand that this is a long-term play, and you should be able to be reliable for that. But I would say
Got it.
that if you understand the LP role, you know that it's not going to be that much hands-on investments. It's more or less. I would say that the capital is the most important thing there is, and also you need to understand that as an LP, you have a limited liability, which means that you are not personally liable for what happens in the fund, and you have to make sure that you are not going to get a role where you might have some other liabilities there as well.
Yeah. Well, maybe we can now kind of go into, diligence and the decision-making process. So, for somebody who's investing as an individual LP, could you maybe walk us through some of the critical steps in performing initial due diligence on a fund or fund manager?
Could you repeat that? I didn't hear that.
Yeah, sure. Sorry. I was just asking, could you walk us through, what are some of the critical, steps in performing due diligence on a fund or fund manager?
Okay. I would say that it depends. If you're investing in established fund managers who have been, around for 20 years, it normally starts with track record. And that might be sometimes, even for those people, quite difficult. You get into the historical data. You have these, like IRRs and TVPIs and DPIs. With those guys, you get with the exit history as well, what kind of exits they made. Uh, you get into the loss rate, focus, and specialization, how they source deals and stuff like that. They've been value add to these portfolio companies. Uh, but then obviously the most important thing is about the team. How to evaluate about the team. Uh, you go through the backgrounds of the key individuals and team members, about their industry experience, their investment experience, if they've been founders, operators, and stuff like that. But I would say that regardless of the type of fund manager, it's always about the team, even with established, but even more so with, I would say, emerging managers where it might be difficult to have that access to the deal to the I would say relevant investment track record. Also, you need to know the due diligence process, uh, how they make decisions, and stuff like that. You need to understand the fund stage, size, focus, strategy. that kind of stuff. And finally, you have to conduct reference checks. If they have already LPs from the past, you talk with them. You talk with founders. I think founders are the most important. Then you try to check out their industry reputation, and also uh, about their investment process. Are they disciplined? Um, do they make ad hoc decisions? How they construct the portfolio and stuff like that. So it's relatively, I would say, long term. It's relatively complicated. Sometimes, if possible, what kind of risk management there is around legal due diligence, regulatory compliance, uh, what is their competitive positioning in the market. Then you try to understand alignment of interest. Do they have the same interest as LPs do? And then, you kind of need to understand about the fund life cycle as well. So
Totally.
it's a summer. There are a lot of different things you need to do, and that is one of the reasons it might take a long time. But I would emphasize the team and reference checks, because I mean, I think that is the most important thing there when you conduct the due diligence on them.
Yeah, there's obviously a lot there, right? And if only there were a program, right, that could educate folks on how to sort of do this diligence properly.
Yeah, and I
Um,
think that it's a process, and people sometimes ask me about red flags and so on, and why did you make that decision? It's always a sum of different parts there, and that's
yeah,
one of the reasons it takes time. But I think it's worth it. You definitely need to spend some time with the managers and talk with them, interview them and get to know them.
perfect. So just a reminder to folks as well, feel free to start populating the Q&A with questions. We're going to do a couple more questions with Marco, and then we'll jump into, audience Q&A before breaking to the networking tables. So Marco, we got into kind of due diligence. One of the things I want to talk to you about as well is the idea of adverse selection. And specifically, how can, sort of newer investors in funds, make sure that they are, not falling into sort of the adverse selection trap. Um,
Yeah,
any thoughts there?
it's a good question because it happens to everybody once in a while. Even those investors who've been around for a long time and they're pretty successful, I would say that they get it right about the best ones around 70 to 80%, and then they hit and miss. You can't have a perfect batting average. But obviously, for new ones, I would say the new LPs, the first thing is that what I recommend to everybody, learn the basics first. And you should really try to network within the industry if possible. And that means that you should attend the events, uh, the conferences, meet other investors, LPs, join groups if possible. There are these clubs and angel groups. If you have existing relationships, if you know somebody who's been doing it, in the past from your personal network, a good starting point is because it's difficult to access these established managers for a new for a new LP. They're very busy and they spend their time mostly with founders and their big LPs. So one of the good ways is to learn to know emerging managers because they tend to have more time. They're building their company funds and track record. So I think that if you're able to identify and meet these emerging managers, it could be helpful. The other thing is that if you happen to, you know, find emerging managers that are going to be successful, they're always going to remember you. if you happen to invest in their first fund. I mean, that you're going to be friends forever. It's difficult to be friends forever with guys like from Sequoia because everybody wants to be their buddy already. But I would say that that is important. Um, then again, you might, if you start investing, which is always a good thing, you can start small and create your own reputation by being able to find good funds, and you get reputation as a good fund picker. Um, Sometimes fund of funds can be helpful. They know a lot of people, they have good access, and you might be able to, by investing in a fund of funds, get information about diverse managers, and they might be able to make some intros to you as well. So that is one way of doing it. But I would say emerging managers are a good starting point sometimes. Being active with your networks and all kinds of industry events. You got to be active there and mingle and get around and stuff like that. Uh, and finally, you have to. I should be able to demonstrate that you are patient, you're committed to the asset class. Uh, Basically, the top managers like people, LPs, who want to create long-term relationship with them. If you talk with Barry Eggers, Lightspeed, highly successful. They still think that that is the best thing about being a good LP, that they understand that the interest align, and then again you have to be patient and understand sometimes that it takes time. Meet as
Absolutely.
many people as possible, uh, and then if you have some networks, if you know some people, even better.
No, that's fantastic advice. Um, so, Marco, maybe just a quick reflection question. I'm curious, what's a piece of advice you wish that somebody had given you when you were sort of first starting out as an LP?
Um, Well, the first piece of advice that I got from a friend uh, must have been like quite a long time ago is that he told me that you should focus on the quality of the general partner and their team instead of like looking at only at the past performance. Um, and I asked him, why is that the case? He said that you got to understand that in this asset class and in many other asset classes and in many things that people do is that it's actually people who drive the performance. Whether it's a startup or a fund, it's like the skill, experience, and so on that there are the most important factors there. And also try to find people who have integrity, uh, where the interests align. That's very important. And then again, try to build up a long-term relationship. But I think that he said that um, look at you try to find the good people. It's so much, the performance is driven by the key persons in a fund, and um, don't try to make this too easy for yourself in a way that you think that it's only the past performance. And he also explained that the reason for this is that we try to find in this world of high insecurity and risk reward things that we think that are tangible. We kind of think that the past track record is something that is tangible. It is not as tangible as we think. We need to understand and find a good team and the good people. That is something that it took a while for me to understand that. Um, and it's what it really means that you have to prioritize your due diligence and concentrate on the team.
Yeah, I couldn't agree with you more. It really, does come down to the people. So, last really quick question before we move into Q&A, Marco. I'm curious, what is your favorite thing about being an LP?
My favorite thing.
You had to pick
Um,
one.
yeah. Um, I, if I answer to this question like this, that I've been a founder, co-founder, an entrepreneur, family office, GP, and an LP. The best time of my life was when I was a founder entrepreneur, by far. That is something that I like the most for many reasons. Uh, the LP, uh, maybe the best part for myself for being an LP is that you get to see a lot. If you're active, I mean, hundreds of managers and pitch decks and whatever. You just sometimes the GPs don't understand how much LPs know,
Hmm,
and that is probably the best thing is that there is unlimited amount of information for you if you want to get that information, and you kind of understand the big picture. And I would say that it's also important for GP to understand that the LPs are the clients, not the founders. The founders are the product.
I
And
love that.
that is something that maybe um, is the best thing. And the it's a difficult question, but I would say that the ability and chance to get a lot of information about what happens, what's going on there, and it's your curiosity that sets the limit. It's totally
Love
up
it.
to you.
Yeah, I love that the curiosity line. Well, terrific. Marco, thank you so much. And just so everybody knows, Marco is going to be sticking around at, heading up one of the networking tables after. So if you've got, more questions for him, feel free to ask him those. And with that, we'll kind of jump into the Q&A. I see there are a couple of great questions here. You want to get a question in for either, Marco or myself related to anything limited partner wise or the program, feel free to get those questions in now. So let's start with Gilberto is asking kind of a hypothetical, I guess, of there may be some really good fund managers working toward a first close, but may not ultimately hit their full target fund size. So, what happens to portfolio construction if somebody invests as an LP in one of the first closes of the fund, but the fund ultimately doesn't get to its target fund size that the portfolio construction was initially based on?
In it's a good question. I would always recommend to GPs to set up an initial target size for the fund that would be realistic and they would expect to get that target size. Because obviously, it happens once in a while that let's say that you want to have a $100 million fund and you told the LPs that you aim to invest in maybe 20 companies in seed, late seed, or A rounds, and you have the portfolio construction and the metrics. And if you are able to hit 50 million instead of 100, it really means that it's a problem with the portfolio construction, and it happens. And I would say that it's always better to uh, have a real, portfolio construction model which is realistic to your target size. And then if you get a little bit more money, it's not a problem. But from a portfolio construction point of view, it is almost always at least a small problem if you can't hit the target. It's like that. It's not a big problem if you are oversubscribed a bit. And the piece of advice that I would give to GPs is that set that target to be realistic, because obviously, if you promise them to do, if LPs to invest in a certain amount of companies with certain valuation, and then you tell them that you're going to do exactly the same thing with 50% of the initial targeted capital, it kind of makes sense that it's going to be difficult. And what normally happens is that instead of writing $2 million checks, they say it's going to be 1 million, which also means that the initial ownership after the initial round for them would be smaller, and it really um, it's you know it's not a good situation in my opinion.
Yeah, great. So we've got another question from Jeffrey, who's asking, at what deal size or, so sort of check size or number of investments do you recommend LPs really start more strictly adhering to, consistent check sizes or kind of more rigid rules around, their own sort of portfolio construction or diversification within their allocation to funds?
I would recommend to write about the same size of checks when you're investing in funds. And I we had this guy from I think the LP Institute last cohort, and they are very good and very experienced, and one of the best ones. And even they said that they should have been investing into these funds with similar check sizes, because they simulated that, because it's so difficult to get the winners, and sometimes you get overexcited about something and you invest a bigger check. I think you should have a discipline and try to invest around the same check sizes to get the returns. I would recommend that, to be disciplined and around the same size. And also, you have to diversify um, geographically, if possible, styles, sectors, stages. But sometimes it depends on your resources and how much capital do you have. But I would recommend that, if possible, that everybody should be able to invest in more than just one or two funds.
Hmm. Okay,
That's the ideal
very helpful.
situation. Yeah, and for the institutional investors, what we try to do, that we try to allocate about the same amount of money every year and write about the same size of the checks. Uh, that's what we did.
Got it. So we've got a question too from Howard. What are the types of liabilities, if any, you could have as an LP? I had thought you could not have any personal liability.
No, you don't have any personal liability. That is the idea about being an LP in a fund, and you should make sure that you won't get any liabilities there. Sometimes there could be some liabilities if you are going to be a member of an advisory board that actually is able to make the investment decisions, which I don't recommend at all. So the whole idea is that the capital you can lose is your commitment, and
Got
try to
it.
make sure that you won't get any other liabilities, because it kind of kills the whole idea.
Yep. Makes sense. All right. Well, somehow time has just flown by. We've got about 20 minutes left in this session. So I think this is probably a good place to break. We had a couple of really great questions there. So, at this point, I think we'll move to the networking tables. Just want to give a big round of applause. Feel free to do some emojis for Marco. Obviously, he has just an amazing, breadth of experience. And, if you want to have more fantastic insights like this, get your application in for cohort 3 starting
Yeah.
in October, and you'll get plenty of opportunity to ask more questions of Marco
There
and,
is
the team.
one thing that I want to say, is that I do want to apologize that I'm a little bit tired. I spent 8 hours at the summit, uh, where I met a lot of GPs and founders, and I just came directly from that summit. And it's pretty tough, because you kind of meet 200 people, and every one of them kind of wants to sell something to you. So I feel a little bit.
I never would have noticed, Marco. You
Yeah,
seem
but I
spot
just,
on with your answers, so don't
I
worry about
almost
it at
fell
all.
asleep, but I hope that you did not. But a tough day for me.
No, I thought this was a terrific conversation. So if everybody just kind of stays on the platform, if you're not familiar with AirMeet, we'll sort of transition. It'll be a slightly different looking screen with a couple of tables. You can just click into the table to join one, and we'll have some folks from the team who are kind of moderating the tables and helping facilitate some conversation and networking there. So thank you all for coming out. We will be having another event next week as well, if you'd like to join us. So look forward to getting to meet some of you. And thanks again, Marco.
Do we have a round table after this?
We do. Yeah,
Okay.
just the networking tables. Yeah.
Okay, very good. Okay, thank you.